Good afternoon, ladies and gentlemen. This is Barry Norman on behalf of Investing.com, and welcome to our three-part webinar on Japanese candlesticks. Now, the class is broken into 3 sessions. Today, we're only going to be discussing the proper understanding of how to read a candlestick, what it means, how it's built, and start looking at some of the rules about candlesticks so that we can get rid of all the misconceptions you all have out there, and you can spend the next week trying to learn and understand what an actual candlestick tells you instead of just thinking reds and greens means ups and downs. Now, candlesticks are a form of charting developed by the Japanese rice traders in the 17th century and brought to the Western world much later, and has grown in popularity with the development of the internet and computerized trading, where now traders have the ability to set up candlesticks easily. Back in the old days, when you had to actually draw these on charts, they were quite time-consuming and complicated. So most traders that were hand charting did not do this. And then even when we got the first computerized charts, they didn't offer candlesticks. And now they're offered everywhere, and everybody tries to trade with them because they're the buzzword of the marketplace. And every newbie trader wants to tell everybody they're trading with candlesticks. Well, it's a big mistake, because first you have to understand and learn what the candlesticks mean and what they're trying to tell you. And this is very, very important, because most traders don't put the effort into learning what each individual candlestick is trying to tell you and what groupings of candlesticks are trying to tell you. And they just make assumptions based on the amount of reds and greens that they're seeing. Now, each candlestick represents a data set of the complete price action during the selected time frame that you had chosen. In the diagram you can see red candles and green candles both having wicks on either end, and the actual main body of the candle represents the relationship between the open and the close. So what we're looking at is the building of an actual candlestick. So what we do is we put a line across at the open price, and we put a line across at the close. So if you're using a 30-minute or 1-hour time frame, you draw this at 1 o'clock, say, and at 1:59:59 you draw the close. You then draw a dot, or you put a dot at the highest level the candle went and a dot at the lowest level the candle went, and connect those to the body. And these are called wicks. Now, this is the body of the candle. If you move down from the open to the close, it's considered a bearish candle. It's a bearish movement during that time frame, so you would color it in with red. Now, lots of new charts offer you all different kinds of colors you can use. So you have a bearish color and a bullish color. We're going to make the assumption for this class that we're using reds and greens. Red are bearish, green are bullish. Now, when you have the open here and the close here, you would then have a step up, and therefore you'd have a bullish candle. Now, candlesticks tell you the battle of the bulls and the bears in the marketplace. And it is a combination of the body and how the body sits next to the previous candle and the length of the wicks that tell the complete story. Okay, not whether they're just reds and greens. So we have to learn what this candle is trying to tell us and what it's trying to tell us in the position in which it is located. So remember, we have the high, which is called the length from the highest point to the candle is sometimes called the upper shadow, or we just call it the wick, the upper wick, and the length of the lower wick is the length from the close or the open, depending on which it is, to the lowest point in that time frame. So we have 4 basic pieces of data, the open, the high, the low, and the close, but then we get to see a whole bunch of stuff based on the size of the candle and the length of each wick. Now, most people, like myself, prefer bar charts. And candlesticks are sometimes more visually appealing and seem to be easier to interpret because, unfortunately, too many traders let their minds go and we see abundance of red or we see an abundance of green and we make assumptions. Because we're human beings, we react. So I stay with bar charts because I take the whole reaction out of it. And the fact is, unless you want to learn to use candlesticks properly, you're better off staying with a bar chart. Because a bar chart uses the same 4 pieces of information. In fact, the bar chart is sometimes referred to as an OHLC, open, high, low, and close. So what are the differences? It is the interpretation of the move and what the size and the shape of the candle are trying to tell you. And there are 6 basic candle formations. Okay? And these describe the battle of the bulls and the bears, or a game. Imagine it's a game, and you have 2 football teams, and you want to see which one dominated the play, which one dominated the quarter, and who was rushing in which direction. So number 1 is what we see on the chart is called a long white candlestick. And that tells us the bulls controlled the ball for most of the game. So in the red and green scenario, this would have been a green candle, okay, with a relatively balanced wick on either end, tells you that the bulls had the ball for most of the game. In number 2, which would also be a red or a black, is the exact opposite. The bears controlled the ball for most of the game. Number 3, which is a very important candle shape, it's got a open and close are relatively the same. They're very, very small. So therefore you have a very small body and the wicks are very, very tiny. This tells you that nobody could decide what to do in that. So everybody kind of stayed right where they were. In number 4, now remember we have for each candle, we have a bullish and a bearish view. So in number 4, we have the bullish control when you have the white candle or the green candle, and then bearish, which is just the exact opposite. Now in number 4, if you notice, the bulls or the lowest point in the session was extremely low. Okay. So that meant the bears really pulled the market way down, but the bulls were able to come back at the end of the session and maintain their control. So number 4, a longer, lower shadow indicates that the bears controlled the ball and part of the game, but lost control by the end, and the bulls made an impressive comeback. Number 5 is just the upside down version of the 4s, and this tells you the exact opposite. Here you had a much, much higher high, but closed way down much lower, even though your close was higher than the open, and it told you that the bulls rushed off the line and moved forward. Okay. Now, they weren't able to control, and they gave back up the control to the bears, and that's why the open and the close were relatively the same, even though you had a lot of movement in that session. So the longer upper shadow indicates that the bulls controlled the ball for most of the part of the game, but lost control by the end, and the bears made an impressive comeback. Just the opposite of number 4. And number 6 is a very balanced candle where the wicks on either end were relatively the same, and the price ended up with no movement virtually in the center of the wicks. So number 6 tells you a long upper and a long lower shadow indicates that both the bears and the bulls had their moments during the game, but neither could put it the other way, resulting in a standoff. Now, these are general stories of the market, because if you can look at a chart and tell a story, actually tell a story. I tell a story instead of using the football story, I'll tell a story of a tug of war. But when you can actually look at a chart and tell a story from the movement, you're starting to understand what is going on in the markets. Okay? And this is what most people don't know or can't do. Okay? Each one of these movements, whether it's a candle or a bar, does tell a story. And ultimately, it's all a story about dominance of the market. It's all about market psychology. So now, don't get yourself in the psychological response to a group of reds or greens. These do not say take a position, and don't let your mind be swayed. Okay. Now, we have long versus short bodies. The body of the candle is crucially important because ultimately it tells you who controlled that segment of time. Okay. And it's very, very important to know who controlled that segment of time. So the longer the black candle is, the further the close is below the open. This indicates that price declined significantly from the open and the sellers were aggressive. After a long advance, a long black candle can foreshadow a turning point or mark a future resistance level. After a long decline, a long black candle can indicate panic or capitulation. Now, a lot of you guys are writing in questions. Okay, the fact is, let's start out. This is not, number one, a personal consultation. Okay, so writing in questions that only involve you personally is not going to get an answer because we don't have the time to deviate every time somebody asks a personal question. The second part is this webinar or this series of classes has been broken into 3 very important sections. Okay, just because you have a question, it's not part of this session. If we don't get to the stuff at the end, you can ask all of the questions. But to start asking questions about, does this tell me where I put my stop loss? We're not even talking about initiating a trade. We're not talking about making a trade, looking at a number, or booking a sale. We're talking about reading a candle on a chart. And this is what you have to stop and learn and listen. And this is what too many traders don't want to do. They don't want to stop and learn from the basics. Okay, if you understand the basics and the foundations, you'll be able to follow everything on a chart or make your own decisions successfully because you'll understand what's going on. And it's crucially important to learn all the basics. Just like I can't put you in a car and tell you to drive. I mean, I remember when I was teaching my daughter to drive a car. Okay. Oh, Daddy, I know. Just give me the keys. Yeah, she thought she did know because she knew put the car in drive and push the gas and you're going to go forward. But that's only how to make it go forward. Doesn't stop you from getting accidents, doesn't teach you how to control the speed of the car. It doesn't teach you how to reverse. It doesn't teach you how to parallel park or make a 3-point turn. These you have to learn. And if you don't understand how to adjust your brake and your pedal and use your mirrors and understand these things about cars and what the signs on the road mean and what speed limits are and how to adjust, you're just going to kill everybody. So what we're trying to do is give you the basic foundation so that you can build on that foundation. So please don't think that I'm ignoring your questions, okay? But the questions are not appropriate at this point. If you want to ask a question that's appropriate at this point, I'd be glad if it's important to the whole class to answer it. But to fill up my screen with, well, do I use this to put my stop loss? Do I use it to take profit? Can I use it for intraday? How do I make a trade? Isn't appropriate at this point. In the third class, it would be appropriate because that's what we're going to be talking about. So let's move forward and getting the basics of your foundation. So we have long upper shadows and long lower shadows. Both of those are very important because it tells you information about the trading session. I'm sorry, somebody just wrote an apology into me. Sir, or who, I can't tell from your name, it's a very unusual name. I'm not lecturing anybody that said anybody did anything wrong. Okay, so please don't misunderstand it. My screen is filled with 50 different questions, okay? And nobody did anything wrong. I'm glad you're here, and I'm glad you're part of an active class. It's just in order for us to get through this and cover everything everybody needs to know out there, we have to go in an orderly fashion. Okay. So long shadows, candlesticks with long upper shadows or short lower shadows indicate the buyers dominated the session and bid the price higher. However, sellers later forced the prices down from the highs, and the weak close created the long upper shadow. So in other words, the bulls had control of the markets, but they weren't able to hold it, and the bears were able to make a comeback, not to take dominance, but able to make a comeback. Conversely, it's just the opposite. Now, once we have, or we can read these 6 stories or tell these stories, because remember, the market is all about dominance. Who's controlling the ball? Okay, who's about to get pulled into the river when you're doing a tug of war? Okay, which side is winning? Because you can only predict ups and downs by understanding the battle. Okay, regardless of how far the battle is going to go, regardless of what prices can be obtained, in order to obtain that price, somebody has to be in control. Okay, and just saying I have an uptrend doesn't tell you control, where candlesticks define all this. Now we go into some very odd name things. And as we learn about these single candle patterns, they do have odd names. The fact is, you don't have to remember the names. You don't have to remember the 6 patterns I just showed you. What you have to do is understand what you're looking at and what it means. That's the ultimate importance. Now, Marubozu candles are very prominent. They happen all the time during a trading session. Okay. Now, they are unique. A Marubozu is a long body that has no wick. So that means that the market either opened and climbed the steadily part of the marketplace and closed at its highest point. Or in the opposite, it opened and fell the entire time and closed at its lowest point. That tells you that there was complete, utter dominance in that trading session. So as you can see, these are candles without wicks. And depending on whether they're green or red, it's either very bullish or very bearish. But that's telling you that at the end of that trading session in the green candle, that the bulls were in the market as strong as could be. So what does that kind of predict for the next trading session? The bulls are going to stay in domination. Now we want to see if they're going to get tired out. Were the buyers exhausted? Did the buyers all buy up in this previous session and they're no longer in the marketplace? Okay. Now, we're going to see that from the next candle. And this is why candlesticks are about 2 and 3 candles together. But this is called a Marubozu. And they happen very often, but they're very important when you see them. Now, even more prominent than long candlesticks are the Marubozu brothers, black or white, red and green. Marubozus do not have upper or lower shadows and are very important. And it tells you who the sellers or the buyers dominated the session all the way to the last trade. Now, when you see a Marubozu form in an uptrend, so we can see on the chart here, on the left-hand chart, the price of the market was moving upward. When you see, okay, the Marubozu, or actually we have a trending market, okay, here, a sideways trending market that is trying to make a breakout. When you get the Marubozu, it's telling you the bulls now took control. They believe in this movement and they're going to push that market up. And therefore you have the beginnings of an establishment of a very strong uptrend. that happens sideways also, and it happens most coming off of the opposite trend. So this is coming off of an uptrend. The price has moved into a sideways movement, and I'm sorry, this has come in after sideways of a downtrend, moved into a sideways movement, and then the bulls took control. Here we're moving in from a downtrend, okay, went sideways and range traded, and then we saw a Marubozu. That's telling you that there's a very strong downtrend beginning. Okay, and we're not talking about just a movement, we're talking about a very strong downtrend. So this is telling you what the buyers or the sellers are going to do in the market. It's not telling you about where price is going to go. There's nothing in this signal that tells you at what point to enter or exit a trade or where price might go or how far that trend will move. All it's telling you is that when you see the Marubozu, that somebody has taken complete dominance of the movement in the marketplace. Now, we have another single candle, and it's called a spinning top. A spinning top has an equal distance wick and a small body. A candlestick with a long upper body shadow and a long lower body shadow and a small body are called spinning tops. Okay. These are what you saw in that sixth description box. Okay. Now, when you see a spinning top, it's very important that you notice it because you're going to be looking for a spinning top in a specific position. And when that spinning top positions itself, okay, it becomes something slightly different and tells you something about the market. Now, from here, we're going to go to a very classic, one that you hear all the time, and that's a doji. Now, a doji has a small wick up and a small wick down and virtually no body. Okay. If it has a tiny, tiny, tiny little body, it's all right. But a doji should look like a cross. Okay. Like here. Okay. Now, a pip or if you're trading stocks and it's at 10 cents, it's all right because they're not going to be exactly the same. But this tells you the open and the close were virtually the same. Okay. Now, the difference is spinning tops are almost the same, but spinning tops have a difference between the open and the close. It's just a small body. Okay. And they have longer wicks. Basically, with a doji, you had almost no movement in the session. Now, it's not a completely flat with no wicks. It's got a little wick. It has got an open and a close, and it looks like a cross. Dojis are very important to recognize, but dojis convince a complete sense of indecision or tug of war between buyers and sellers. Price move above and below the opening during the session, but close at or near the opening level. The result is an ultimate standoff. It's a session where nobody could have made any money. Now, we do have other views of doji because the doji is more about the body than it is the wicks. So we do have the doji when it has a up or a strong down because that's usually a blip in the market. Okay, something blip, but it means at the end of the session, the beginning of the session, there was no commitment. Now, it could have had some type of volatility for some reason because a low can blip down for one trade and then blip back up. Okay, but we're still looking for the body. No body. Dojis happen a lot. Now, it's important to look at a doji in conjunction to a trend. Okay, because a doji is very important when price is moving either in an uptrend or a downtrend, or the bulls and the bears had control of the market, because it's telling you when there was somebody in control of the market the previous session, and then you get a doji sitting next to that price, meant that the buyers and the sellers were totally unsure, and they're becoming evenly matched, and you're probably going to see the end of the current trend. Okay, means in an uptrend, the buyers are losing faith. The bulls aren't strong enough to pull it down, but they're indecisive. But most likely, you're going to see a trend reversal. Whereas if you had gotten the spinning top, it's a sign of indecision, not of a trend reversal. So they're very close in view. Okay, they are different in interpretation. Okay, after this, we go on, and there are many, many, many more dojis. But a doji is a candlestick where the open and closing prices are the same or almost the same. It can take many forms depending on what trading activity was in that period. So this is the first time that you're actually going to have to look at what is happening on the chart. Not the previous candle, but you're going to have to be looking and understanding what is happening on the chart to actually interpret a doji. Now, what's key with a doji is that neither the bulls or the bears have gained control, and that the price has ended where it began. It's a signal of indecision in the market, and could be used in conjunction with other indicators to signal a change in market direction. So when we see now in this case, we have a fairly strong downtrend with a confirmed trend line. So we have an active trend line, so that's good. And what we got here was a doji. Now, we were in a downtrend, price bottomed and moved up to an uptrend, a short-term uptrend, and here it came to the trend line. And what do we got? We have a doji, and look at what we have right after it. Okay. And it's telling you the price cannot break that trend, and it's reversing and moving down. And it moves strongly down for the next two time frames, but then the bulls came back and pulled the price back up, but the bears eventually took over dominance because this price and the trend line was becoming a strong resistance level. But when we had the doji, or can somebody tell me what this is? It's got a smaller body and a small up and down. What is that on a chart? Remember? We had a doji or we had a spinning top. So this has some definition. So this is more of a spinning top, but it gave you the same clue. But look at where the upper wick went. It went right to that trend line and bounced off of it. Now, again, we have to then look at that in conjunction with the previous, and we're going to look at it for the next trade because you're not going to trade from a single candle. You're going to look at it in conjunction with the previous candle and with the next candle. Okay, because the next candle will confirm what the previous candle told you. Okay. So again, we're not determining price, we are determining market control. No, Jens. Jens asked, you said that the interpretation of a doji and spinning top are different. In this example, they're the same. They can be the same. A doji is representing a good trend reversal, a market reversal, where a spinning top is telling you there's indecision and could be a reversal. One is more definitive than the other. That's all that the difference is. One's telling you that a spinning top is telling you that the market is very indecisive. A doji is telling you that they've lost, it's beyond indecisive, okay? The whoever dominated the market in the previous session has now lost control, basically. Then we go over to another version of the doji, and these are called gravestone and dragonfly. Why? Because they kind of look like they are. They have very long movements in one direction. These can give you reversal implications. Okay, what we're looking at whenever we get a specific candle and a sign is, will the market continue in the trend it's going, Or will the market reverse from that trend? And you're simply looking for clues. And what I'm also telling you is when you get the clue, you have to look at the next hint. So you get a clue and then a hint, a clue and a hint. And you have to firmly look at it. And by telling the story, you will kind of understand, because what happened in here? The price opened and closed virtually the same, exactly the same. The bears never could control it all, never pushed the price up. The bulls, the bulls could never push the price up. Somehow, some reason, the bears took a running start, but then petered out. So for some reason, the bears started trying to push that price down, but something happened that the bears said, uh-oh, we can't do this. Okay. Again, it's telling your story. And that's what's important is right now, we're not making, again, trading decisions. We're trying to make up a story. Like I said, if you imagine that you were at a picnic with, a whole family and all your friends, and you're out by a stream, and all the guys decide to play tug of war. 10 guys take the rope on one side of the stream, 10 guys take the rope on the other side of the stream. They're tugging back and forth. Now, Tommy, who's on the green side, got pulled into the water, okay? But he was able to get his legs back and pull everybody back, and he tugged so hard that Billy and Bobby on the other side fell into the water. Okay. While they were in the water and they couldn't get the grips back, the guy at the back, he had to go back see his wife, or the baby started crying, so he let go, and it's all this constant tug of war, and it's a story of what's going on. It's understanding what the candles are trying to tell you. So we're going to look at some guidelines. Then we're going to start looking at multiple and single candle patterns, because right now we're not looking at a pattern. All we're looking for is interpretation. And we have to then move to the next level. Okay. And now that you have some idea of what basic candlesticks indicate with their bodies and wicks, let's cut our teeth on some simple and uncomplicated candlestick patterns, because these patterns get very complicated, very complex. Okay. But this is all leading up to helping you make price decisions, to understand price action and make a determination. Now, single candles are fairly common and quite likely to appear before you in a normal trading session. So knowing instantly what they mean and taking the proper trading decision immediately could make the difference between a winning and a losing trade. Because a lot of times those candlesticks we looked at aren't giving you a trading signal. They may be telling you maybe you want to exit what trade you have. Maybe you set a target, or maybe your stop loss in the wrong place. Maybe you want to exit the market at this point. Close your trade with the profit you have. Because all times, even though we set a target rate, we want to know when to close our trade so it doesn't dip down and we don't lose some of our profit. Or we want to worry that maybe, how do we know if it's just not an easing in the trend and we should stay in the market because the trend's going to continue up, and if we got out of the market, we could lose 100 points. Only because we exited too soon. So it makes a difference understanding what is going on. Now it's learning the positions of candlesticks. And we go into standalone, doubles, and triples. Standalones are quite common. Okay. So we don't want to put a lot of validity onto them because they happen often in a trading session. But we have to understand what they're saying. And these all have names. Okay. But again, just like remembering a doji and a Marubozu aren't important. You can just remember that's an icky of a candle. It's got no wicks. Okay. That's a candle that only has no body. I don't care what the name is. You know what the story is. Now, a candlestick that gaps away from the previous candlestick is said to be in the star position. Okay. Why? Because it looks like a star above the previous candle. Okay. We have morning stars and evening stars. Morning stars because they gap upward, evening stars because they gap downward. Okay. Now, depending on the previous candlestick, the star position candlestick gaps up or down and appears isolated from the previous price action. Because, as you know, price always has to open where it closed. Okay, so you have the close up here, okay, and it looks like this candle gapped away from the price that is sitting above. Okay, now the two candlesticks can be any combination of white and black. The color is not important. Doji, hammer, shooting stars, spinning tops have some real bodies and can form the star position. Okay. So, does it make a difference what candlestick is in that star position? No. What we're looking for is the position of the candlestick. Now, later we'll examine 2 and 3 candlestick positions. That candlesticks that gap away from the previous candle is said to be in a star position. The first candlestick usually has a large real body, but not always. And the second candlestick in the star position has a small real body. But depending on the previous candlestick, the star position candle gaps up or down and appears isolated from the price action. The two candlesticks can be any combination of black or white, red and green. Okay. Doesn't matter if they're dojis, hammers, shooting stars, spinning stars, all have the same real body and can be formed in the star position. So, the pattern looks just like the inverted hammer, but shows up after the upswing in price. Why shooting star? Because it looks like a star falling out of the heavens. So what do we have? We have morning star and an evening star, and then we have shooting stars. Shooting stars, okay, are because it looks like a star falling from the heavens with a long flaming tail. Okay. So it just depends what happens to the bull. So here we have price in an uptrend, and then we see the shooting star if it appears in an uptrend, okay, and if it appears in a downtrend, it's just the reverse of the uptrend, and it's called an inverted hammer. Okay, so what do we see? We see a long wick. We see a gap up. We see a small wick, and we see a small real body. Okay. What we're looking for is the small real body, and the fact is that it gapped away. Okay. This is what's crucial in the stars, that they gapped away, and they look like they're stars sitting next to a candlestick. Now, the hammer or the hanging man is a candlestick pattern that consists of just one candle, although with candlesticks, it's always best to view them in context of the candlesticks around them, in particular the candle that follows immediately after. The hammer or the hanging man candle has a long lower wick and a short body, and little or no upper wick. Strictly speaking, the lower wick should be at least 2 times longer than the body. And the longer, though, the better. And depending on where you find it on a chart, it's either called a hammer or a hanging man. Okay, it looks just like it is. A hammer is found in a downtrend and signals a bullish reversal. Okay, so when you see it in a downtrend, it's signaling the market's going to reverse and move in the opposite direction. It's a period in which sellers were in control, but the body shows the buyers have come back. From this, we can tell that there is a strong buying by bulls as the period of sell-off declines. As with all single candlestick patterns, we should wait for the next candlestick to confirm that the buyers are in control. So this is signaling you of the bullish reversal. Now, again, there's no guarantee, so we always want to wait to the next candle. When we have the next confirming candle, we can then know the price is moving into an uptrend because the buyers have taken back control. Okay. Again, the prices are not important. They'll be important later in determining entry and exit points, stop loss, and take profit point. But right now, it's only understanding where it should move, where the price is moving, where the trend is moving. Okay, a hanging man is the same shape as a hammer, but found in an uptrend, just the reversal. We don't expect to see strong selling pressure seeing a long wick on a candle in an uptrend. So here it suggests a change in market sentiment or a reversal to the downside. Okay, there's no hard and fast rule about the color of the hanging man or the hammer. It can be in either color. the fact that they have a short body already means that there's indecision. Remember, we talked about that in the other patterns, the doji as well as the star. Okay. Small bodies denote indecision, but this relationship to the wicks that tell you the better story. The fact that they have short bodies already means there's indecision coming in the market. However, a green hammer or a red hanging man are stronger indicators. So here we can see this hammer developing here. We're in a downtrend. And we see the hammer develop. And from here, we are waiting for the next candle to tell us how indecisive or decisive the market will be. And in this case, as we see, it was a market reversal. Again, we have it right here. Okay. And the next candle, the hanging man, added the bearish sentiment. So we then got another single candle clue. And we moved into a bearish signal, and we would have seen a trend reversal, or we would have traded the price to go down. Now we come to another funny name thing, and that's the Harami. Now, Harami is another position candle. Okay. Now, it's ultimately about remembering the position that these candles come to. First remember, we had the 6 different types of candles in the very beginning of the class. Then we went to more single candle interpretations. Now we're coming to position. And then we're going to move to pattern. So position is where these appear next to the previous candle. So all that we've been talking about in hammers, inverted hammers, evening stars, morning stars, shooting stars are all about positioning. Okay? Now, Harami is a candlestick that forms within the real body of the previous candle, which means that the entire next price action comes within the area of the body of the previous candle. Okay. Harami means pregnant in Japanese, and the second candle is nestled inside the first. The first candlestick usually has a large real body and a small real body than the first. And the shadow, the wicks of the second candle do not have to be contained within the first, though it's preferable if it were. My interpretation is always that the high, the low, and the body must be contained within the body of the previous candle. We don't care if it's a white or a black candle, a red and green candle. Don't care. It's only the position, because this is a position. So therefore, it must be contained within the body of the previous candle. So if you use the hardcore interpretation and say, this means pregnant, a pregnant woman, the baby would be within the confines of a certain part of her body. Same thing here. Now, the second candles do not have to be, though it's preferable. Doji and spinning tops have smaller real bodies and can form in a Harami position as well. Later, we'll examine candlestick patterns that utilize Harami positions. Okay, so what did we start? We started with the interpretation of the candle. Now we're interpreting where that candle is located in connection to the previous candle. And from here, we're going to go on to patterns. So it gets complicated. So we have individual candlesticks, positioning, and then the pattern that exists with those 3 elements involved. Okay. I'm sorry. I'm just trying to get these markings off your screen. Now, the Harami is one of the most common candlestick patterns you'll come across. So it's important to recognize it and to understand what it means and to understand its limitations. A Harami is a 2-session reversal pattern. It's made up of two candlesticks and implies that the price is about to turn. It, it, it is indicated by a small body of the opposite color, completely contained by the body of the previous session. So if you have the opposite color in the Harami position, it is telling you that the market is about to reverse. If you have the same, okay, it's still a Harami candle, but it's not giving you the same interpretation. Okay. It is not essential for the candles to be in opposite colors, but this tends to give it a much more reliable signal. So as you can see here, the body of the small black candle is completely within the confines of the body of the previous candle. This indicates that the upward trend is running out of steam. Okay, now, because a Harami is so prevalent, okay, it tends to give you lots of false signals, only because you're getting so many of them in a trading system. So it's very important to notice them, but only when you get a true Harami. I mean, and really all the way down by the rules, is it really a good thing to look at? Because they develop so frequently that most traders do not use them for much of anything. So I'll be blunt with you, a Harami doesn't always live up to its hype. While it is touted as a reversal indicator, you may find yourself disappointed by its reliability. The psychology behind a Harami is that the possible change in sentiment may be happening. The small candle does not necessarily mean a strong reversal is coming. Often with a Harami pattern, several days of tight range trading referred to as congestion or consolidation will follow. Harami on its own says the chart might reverse, but that's it. Be aware of Haramis and watch for what they are telling you about the market sentiment, but don't have blind faith in them. So what have we learned so far? We've learned building a candlestick chart, understanding and reading the candle itself, the explanation of candle shapes and sizes, the formation of a candle, the position of a candle. We've taken a look at what dojis are, haramis, tops and shadows, the wicks. That we talked about the bulls versus the bears. We talked about hammers and hanging men, star positions. We talked about falling stars. Okay. And this is where we're going to stop today's class, because now it's time to learn about multi-candlestick patterns. As I told you, there's a lot more than just reds and greens on a chart. And this is where we get into the real nitty-gritty and the complicated stuff. Because what we talked about so far is just the bare basics. I sat you down in the car. I told you where the shift was. I told you what each of, what drive was, what neutral was. We went over what, where to put the keys in the car. And today, it's not even keys. It's how to start the car. It's all complicated in every car, especially with electronic keys and push buttons and everything else. We talked about setting the mirrors. We talked about looking in the rearview mirror. We talked about everything, but you're not ready to pull away from the side of the car. Okay. So at that point, we're going to end the class, and we'll thank you very much for coming, and we'll see you next week for part 2 of this class. Thank you very much, and hopefully you will have mastered all this by next week's class. Talk to you, and I've given you all the handouts. Look in those handouts and start to memorize what all of that means, okay? And that's what you have to have down pat. So start looking at it, start looking at those positions. Again, don't be concerned with trading. Don't be concerned with making profit. Be concerned with understanding what the chart is telling you, and the rest will come. So have a very, very nice day, and thank you for joining us, and we'll see you again real soon. Bye now.